The gold story needs some bad economic data coming. The gold story needs Jay Powell to take a back seat. We are going to take a lot of heat. I'm going to take a lot of heat on this trade, probably until that happens. I believe we could be weeks away from seeing a noticeable change in the economic data that starts to suggest the waiting for Godot recession is actually happening. The labor numbers we have seen, I think, are kind of a big, almost a head fake. They make it seem like things are good in the labor market, and I think it's covering up some deterioration. The JOLTS number, I think, is nonsense. I think people just leave job openings in the JOLTS thing and forget to take them down. So I don't think that's anything to take any comfort from.
The Federal Reserve's more cautious stance on monetary policy is putting downward pressure on gold prices. This is because positive economic data and steady inflation make it less likely that the Fed will raise interest rates in the near term. However, it is expected that the Fed will eventually pause its interest rate hikes, which should support gold prices in the long run. As a result, the recent decline in gold prices is expected to lead to new purchases by investors. On Thursday, the price of gold remained close to a significant support level of $1,900. This occurred as Federal Reserve officials reiterated their hawkish stance on interest rates ahead of important economic data. However, the quality of buying suggests that a significant sell-off is unlikely to occur. One positive factor for gold is the type of buying it has been receiving. Central banks and individuals purchasing physical gold in the form of coins and bars have contributed to the demand. Independent analyst Ross Norman believes that this quality of buying suggests that a significant sell-off is unlikely to occur. Luorio believes that gold prices could rise if inflation remains under control and job numbers are weak. The metals market was hoping for the Fed to tighten monetary policy, but good economic data has made this less likely. As a result, there have been fluctuations in the prices of gold, silver, and copper. Let's hear from Jim Luorio's interview with SOAR Financially.
So today, gold bounced pretty well off that 1900 level. I can't believe it's at 1900. And again, it's been a little bit painful to me, but it responded very well to that. Bitcoin has been going through the roof. The Bitcoin gold ratio is at the highest level Bitcoin that's been in many, many months, which I think is interesting because those things, in my opinion, should trade together, but it ends up Bitcoin trades more with the Nasdaq than it does with gold. So it's very. I think the next time we see the unemployment data, which is that going to be the 7th, right? 7th, I think, is the unemployment data, and I think it's going to be an enormous day because we know now that inflation is coming lower. And it's nice. Tomorrow we have PCE, which is a big deal too. But as long as inflation stays a little bit tame, if we see some bad news on the job front next Friday, I think that's potentially when the move in gold could happen. And technically speaking, it bounced off that 1900 level today. And I think that's a good sign, but it's not. I need fundamental confirmation before I increase my position tandem. So that's why I actually had memorized the gold levels I was looking at too. I still have my silver position on. They've mostly been trading in tandem with, so I wasn't really looking at the levels that hard. The story for silver is the same. And the story for silver too has to kind of almost bleed into the copper arena as well, where not only do we need loose money policies for silver to outperform, we need a belief that those loose money policies are going to spur on economic activity too. Because in my mind, I always picture like silver is like 70% of a precious, 25 to 30% of an industrial. It is used for things. So I think that if we have those two things, silver could do very, very well. But I'm looking at gold more closely for what the metals market really, really wanted was the Fed to overdo it relatively quickly with their tightening cycle and then have to quickly respond by adding liquidity to the market. And remember, just 2 short months ago, that's what the Fed funds futures curve said was going to happen. That's what 2 versus 10 said was going to happen, which still says it's going to happen. But the Fed funds futures curve still says things are fine, and the Fed is not even necessarily going to, ease this year at all. Before, it used to say there was going to be 100 basis points of easing in 2023 and potentially 200 more in 2024. That's all changed. Now the numbers have been coming in good. What's really, really interesting is that the numbers have been coming in good and the inflation numbers have been coming in lower. So this is great for the soft landing scenario, but it's not what the metals market wanted. And that's why we've seen these trade-offs in gold, silver, and copper, which are 3 things I'm fairly heavily allocated to and still am. And in retrospect, there was some technical things I saw when the markets were kind of toppy that I should have hedged some of my positions. I didn't. I'm taking a little hot water on them, but I'm fine. Or taking a little water, whatever.
Experts suggest that central banks around the world are preparing for a new monetary system centered on gold. Concerns about the US dollar losing its reserve currency status have driven increased gold purchases by emerging economies. In the first quarter of 2023, central banks added 228 tons of gold to their holdings, supporting prices despite the hawkish stance of the Federal Reserve. The trend of central banks driving gold demand has been going on for a decade, and it may be a sign that they are anticipating a change in the monetary regime. Countries that are diversifying away from the dollar include Saudi Arabia, Russia, Brazil, and France. While these efforts do not represent a complete shift, they may be a response to the increased gold purchases. China has been actively increasing its gold reserves, recently acquiring 144 tons, bringing its total to around 2,092 tons. Luorio believes that the US dollar is still the most reliable reserve currency despite recent challenges. The US was one of the first countries to address inflation by raising interest rates, which has supported the dollar. While the freezing of Russian assets has damaged the dollar's reputation, it is still viewed as more reliable than other options. He emphasizes that there is no need to worry about the dollar losing its reserve currency status or hyperinflation. Let's listen to Jim Luorio's interview.
And so the thing now is that, in all these calls for the dollar to be replaced as the world's reserve currency don't take into account the fact that every other central bank is just as poor stewards with their own fiat currencies as we are with ours. So you look, and we, by the way, were the first and kind of took charge of the whole fighting inflation thing before others did. One of the only other 2-year yields that's fairly close to us is Canada, but most of the European Union still has much lower 2-year yields, and there's some still inflation. The UK is what I'm pointing to, obviously, that they are going to have to deal with. So we stepped out and started raising rates first. That's supportive of the dollar. That is an excellent thing. Some bad things have happened to the dollar too. When the war in Ukraine began, remember, we froze assets of Russian oligarchs and Russia throughout the world. That's not something that's looked fondly upon if you're the arbiter of the world's trade and your dollar is the commodity. So that belongs on the negative side of the ledger as we're putting those together. But that being said, who will you trust to be the arbiter, to have your reserves in, the dollar or the Chinese yuan? And I think the answer to that is pretty clear. We might not be the most dependable country in the world, but we're a spell more dependable than most of the others, particularly in China. So I'm not worried about the dollar losing its reserve currency status. I'm not worried about hyperinflation that I was before, because it does seem like they've taken things seriously in the last year and a half. I will even argue almost maybe too seriously with raising rates. I am still, overall, let's say 10 years ago, I believe the chance of a hyperinflation currency situation, which I believe is one of the worst types of financial crises, is hyperinflation. That's in Caracas, Venezuela. That's when feral cats and rat population went away because they were used as a food source because people couldn't afford it. I'm not trying to be funny. This is just what happens in those things. So 10 years ago, I put that possibility to 0.01% chance. I think the chance of us getting into a situation where we hyperinflate and our currency becomes something that's not desirable has grown to 3 to 5% chance. Sounds low when people hear it from the outside, but that is ridiculous. When we have the world's reserve currency, all we have to do is not mess it up. And then we have these people come out and pitch things like modern monetary theory, which is the height of absurdity. And I think longer term, there are people who genuinely believe we can borrow and spend as much as we want, and it's not going to affect our currency because other countries are doing it as well. That works right up until the moment it doesn't. So the short answer is that I'm not surprised that the dollar's hung in there, because I believe it's a world of poor stewards and bad central bankers. I've come so much around. I don't even think central banks can possibly succeed anymore. I think the tools they have don't work. And and to tell a politician that, because you own the printing presses, you can borrow and spend as much as you want, is literally like lighting a fuse, in my opinion.
Gold prices are expected to decline in quarter 3 2023 due to anticipated U.S. interest rate hikes. Moderate inflation provides some support. Gold has dropped 2.5% from May's record high, falling below $1,900. Concerns about the U.S. Banking sector initially lowered rate hike expectations but changed with the last hike, pressuring gold. The stronger U.S. dollar and higher Treasury yields reduced gold's appeal. U.S. consumer spending stagnated, but inflation slowed in May. Gold prices slightly increased as traders perceived lower chances of a July rate hike. That's all from us. If you like this video, please subscribe, like, and click the bell icon to be notified of future videos. We hope our content has helped you in your trading endeavors.